Hello and welcome to NDTV Profit. You're joining us in this special broadcast where we are talking about the Tata Capital IPO. It's an IPO that has been anticipated for a fairly long time. And of course, now it's going to hit the market in the week. October 6th, the IPO opens. It will remain open till the 8th. The company is looking to raise about 15,511 crore. This includes an OFS as well as a fresh issue component. I have with me Mr. Rajesh Sabharwal, the MD and CEO of the company. Mr. Sabharwal, welcome to this conversation. I want to start first with the idea of Tata Capital coming to the market. There's been a lot of conversation over the last 2 years because the RBI came out with a list and it said that these NBFCs need to list ASAP if they are not already listed. Of course, if that list did not exist in September of 22, would September 25 or October 25 be the date when you come to the market?
We've been getting full support from Tata Sons in terms of whatever capital we need every year for growth. This trigger of September 25 happened because of RBI placing us in the upper layer. If probably this wouldn't have happened, we wouldn't have been there in the market at this point of time, but would have been there at some point later.
Okay, fair enough. The price band of 310 to 326, that's something that you've now come out and advertised. People point out that the unlisted space values you about 50% more than the value that you're currently quoting. Is this deliberate? Was that even part of the consideration when you're thinking about the pricing of this IPO?
Absolutely not. We do not consider anything on that side. In fact, the way we go about is we meet investors, take their feedback. Our investment bankers, their teams look at, what's there in the market. And based on all that feedback, the board finally decides what needs to be done. And yesterday, the board took the decision on the price band of 310 to 326.
Okay. I want to understand from you, 17th company from the Tata stable to come to the market now. There's a lot of expectation riding because this is probably one of the larger financial services businesses that is coming to the market and a sizable IPO. What is your expectation as the leader of this company? And how are you going to address, say, the market expectation, which is that it's a Tata Group company, it's got a fairly large book, 2.33 lakh crore. You've got a very well-established business. This should actually fly off the handle.
Actually, we are very focused on building a company which will last for generations. And our approach there is to create a business model which will grow at a high pace and also deliver one of the lowest credit costs. And that is what we have built at Tata Capital. If you look at our growth rate, we've been growing over the last 3 years at about 28%, and our credit costs have been below 1% before the merger with Tata Motor Finance. The model which we have built is more resilient because our spectrum of products is most diverse in the industry. We are present in all segments of lending, consumer, housing, SME, as well as corporate, where consumer, housing, and SME form close to about 90% of our total asset book. And within that, also, we have a number of products. Each product is of scale, and each product has a strong growth engine, which allows us to moderate our growth in different segments such that we can capture the India growth opportunity in the most optimal manner and also ensure that our credit cost remains the least.
Okay. Coming to the credit cost point, because you've mentioned it now, at 2% gross NPA, or stage 3 assets, however you want to call it, that tracks with the best in the industry. Having said that, there's been a bit of a spike as of June, right, compared to the last year. I'm assuming this is because of the Tata Motors Finance merger that happened. But in terms of the asset quality of the portfolio right now, is that anything that is a bit concerning? We've had a period of auto loans defaulting more than the other retail assets, but something that you're looking at.
The way I look at it and the way you see our company, before the merger, we've always had credit cost of sub 1%, which is amongst the best in the industry. The merger approvals came in May of this year. but it incorporates the financials as of March 25. We do believe that the segments in which we operate today are in a much good situation. And in terms of credit costs, we've seen the worst behind us. In fact, each segment is behaving very well, whether it is unsecured, whether it is secured, whether it's housing. Each of these segments is behaving very well, and we foresee that we will always be in a region where we can keep our credit costs as amongst the least in the industry. If you look at housing, which forms the largest book for us, that's about 71,000 crores. That's our subsidiary housing finance company. It has credit costs which are less than 10 basis points. So, and it is growing at a pace of over 30%. I think the use of technology, the use of digital and analytics has allowed us to build models which are resilient with large growth, and managing both growth and keeping costs low has worked very well for us.